Hello, my name's Craig Erlam, Senior Market Analyst at OANDA, and today we're going to talk about the pound versus the US dollar. This has quite simply been one of the more attractive currency pairs now for the last few months. Over the last week, we have hit into a little bit of consolidation around that 121 level, but I don't think this is going to last too much longer. The simple reason for this is because in both cases there's just so much happening and is likely to happen now over the next couple of months. This is likely to lead to plenty more volatility on the pound front. Yes, we are into the summer recess of Parliament, but we are also into the early stages of Boris Johnson's tenure as Prime Minister. Boris Johnson has stated that he doesn't favour a no-deal Brexit, but he's also not scared about it, and we will be leaving on the 31st of October one way or another. He's looking at ways to move around Parliament because Parliament is so against no-deal Brexit and the economic impacts that could have. So the fact that he's so open to it and the fact that he's looking for ways to drive it is what's really weighing on the currency. We've seen a big PR offensive from members of his team talking about no-deal preparations and the fact that the economic consequences won't be too severe, which has clearly fed through to negativity in the markets, even if the message that they are sending is far more optimistic. On the US front, we have seen a little bit of support in the US dollar, but it has been on a general downward trajectory really over the past couple of weeks. The Fed, the markets have been pricing in more Fed stimulus, more Fed interest rate cuts, even if the message coming from the Fed itself hasn't been too positive. Of course, the US is right in the midst now of a trade war with China. We've had a lot of news now here over the last week and a half. We've gone from talks in Shanghai aimed at trying to resolve a number of key issues which led to the breakdown of talks previously, to new 10% tariffs on $300 billion worth of Chinese imports from September 1st. We had retaliatory measures from China, banning imports of agricultural products and also letting the dollar yuan slip above $7, a major psychological level which the markets really did grasp onto in the immediate aftermath of that. People warning about the warning that sends, with it being the first time in more than 11 years since that's happened. The US responded in kind again by labelling China a currency manipulator. All of this flaring up in the aftermath of that meeting did come as quite as a shock to many. At the moment, the dollar is holding firm, but again, this is something else that could lead to a lot more volatility in that currency along the way, alongside this disparity that seems to exist between the Fed's view on where interest rates should be going and the market's view, with the market far more aggressive. Although again, as I say, we have seen expectations already start to pull back at that September meeting. James Bullard again suggesting it's not so clear cut that we will see an interest rate cut there only yesterday. With all that in mind, it would be very surprising to continue to see this fine consolidation taking place in the pound dollar against this level. The one thing I will read into it, the one thing I will say about this is, while we've had this consolidation, we're not seeing many rebounds. And when you consider how much of a sharp sell-off it has been, the fact that there's such a little amount of bullish appetite there probably does speak volumes. People are talking about 120 as being a key level, maybe not expecting us to hit these levels quite so quickly. But if we can continue to see this downward pressure building and we're failing to see these rebounds, then it would suggest at least that this 121 level could be a little bit vulnerable, and below there, like say 120, then becomes a massive psychological level for this currency pair. But again, there is two sides to this, and if we do start to see the Fed continue to send this dovish message, and if that dovish message finally does, and if that dovish message is leaped upon by the markets because they haven't been doing so far, then perhaps that does provide that little bit of incentive for a rebound in this pair. But at this moment in time, we're just not seeing that.